Have you ever wondered who's pulling the strings behind the world's economies? It's not some shadowy group in a secret lair. In fact, it's an institution most of us have heard of, but few truly understand. The central bank, whether it's the Federal Reserve in the US, the European Central Bank, or the Bank of England, these financial giants wield incredible power. They are the guardians of a nation's financial stability, and their decisions ripple through every corner of our lives, from the price of your morning coffee to the interest rate on your mortgage. But how do they do it? How does one institution hold so much influence? Today, we're demystifying the world of central banking. We'll break down their tools, their goals, and how their actions shape the economy you live in every single day. Stick around, because understanding this is key to understanding how the world of money really works. So, what exactly is a central bank's main job? At its core, a central bank has two primary objectives, often called the dual mandate: maintaining price stability and achieving maximum employment. Let's start with price stability. This means keeping inflation in check. When inflation is too high, your money buys less and less over time, eroding your savings and purchasing power. Think of it like a leaky bucket. The value of your money is slowly draining away. On the other hand, if prices fall, a situation called deflation, people might delay spending, thinking things will be cheaper tomorrow. This can grind an economy to a halt. Central banks aim for a sweet spot, a small, predictable level of inflation, usually around 2%, that encourages steady economic activity without devaluing the currency. The second part of the mandate is maximum employment. This doesn't mean zero unemployment, because there will always be people moving between jobs. Instead, it means creating an economic environment where everyone who wants a job can find one. A healthy job market is a sign of a strong, growing economy. The challenge for central banks is that these two goals can sometimes be in conflict. For example, actions taken to cool down inflation might slow the economy and lead to job losses. It's a delicate balancing act, like walking a tightrope. Central banks are constantly analyzing data, forecasting trends, and making adjustments to keep the economy on a steady path. Navigating this complex trade-off between controlling prices and supporting jobs. Now, let's get to the exciting part: the toolbox. How do central banks actually achieve these goals? Their most powerful and well-known tool is the interest rate, specifically the policy rate. This is the rate at which commercial banks, like the one you use, can borrow money from the central bank. Think of it as the wholesale cost of money. When the central bank raises this rate, it becomes more expensive for commercial banks to borrow. They, in turn, pass this cost on to you and me by raising interest rates on mortgages, car loans, and credit cards. With borrowing more expensive, people and businesses are less likely to spend and invest. This cools down the economy and helps bring inflation under control. Conversely, when the economy is weak and unemployment is high, the central bank can lower its policy rate. This makes it cheaper for commercial banks to borrow, and they pass those savings on to consumers. Lower interest rates on loans encourage spending and investment. People are more likely to buy a house or a new car, and businesses are more inclined to expand and hire new employees. This stimulates economic activity and helps boost employment. So, by simply adjusting this one key interest rate, the central bank can either step on the economic brakes to fight inflation or hit the accelerator to combat a downturn. It's the primary lever they use to steer the economic ship. Another powerful tool in the central bank's arsenal is something called open market operations. This sounds complex, but the concept is straightforward. It's all about managing the amount of money circulating in the banking system. When the central bank wants to increase the money supply, it buys government bonds from commercial banks. In this transaction, the central bank pays the commercial banks with newly created money. This injects cash into the banking system, giving banks more money to lend out to people and businesses, which stimulates the economy. It's like pouring water into a dry garden. On the flip side, if the central bank wants to reduce the money supply to fight inflation, it does the opposite. It sells government bonds to the commercial banks. The banks pay for these bonds with money from their reserves, effectively taking that money out of circulation. With less money available, banks have less to lend, which slows down spending and cools the economy. So, by buying and selling these bonds on the open market, the central bank can directly control the total amount of money in the financial system, influencing lending and economic activity without even touching the main policy rate. But what happens when interest rates are already near zero and the economy still needs a boost? This is where a more unconventional tool comes into play: quantitative easing, or QE. You probably heard this term a lot after the 2008 financial crisis. QE is essentially a large-scale version of open market operations. Instead of just buying short-term government bonds, the central bank buys massive quantities of longer-term assets, including government bonds and sometimes even mortgage-backed securities, directly from the open market. This has two main effects. First, just like regular open market operations, it pumps huge amounts of money into the financial system. Second, by buying up these longer-term assets, it drives up their prices and pushes down their long-term interest rates. This makes it cheaper for businesses and individuals to borrow for long-term investments, like building a new factory or buying a home, providing a powerful stimulus when traditional tools are maxed out. However, QE is not without its controversies. Critics worry that it can lead to asset bubbles by artificially inflating the prices of stocks and real estate, and that it could eventually trigger high inflation once the economy recovers. Winding down QE, a process known as quantitative tightening, is also a tricky maneuver that can spook financial markets. It's a powerful but blunt instrument, reserved for extraordinary circumstances when the economy is facing a serious crisis. It's like calling in the heavy artillery when the regular troops aren't enough to win the battle. Beyond these domestic tools, central banks also play a crucial role on the global stage. They manage a country's foreign exchange reserves, which are stockpiles of foreign currencies. These reserves act as a buffer, allowing the central bank to intervene in the currency market to stabilize its own currency's value. For example, if a country's currency is falling too rapidly, the central bank can sell its foreign currency reserves and buy its own currency. This increased demand helps to prop up its value. A stable exchange rate is important for international trade and investment, as it reduces uncertainty for businesses that operate across borders. Furthermore, central banks cooperate and coordinate with each other. In a globalized world, a financial crisis in one country can quickly spread to others. Central banks communicate regularly, share information, and sometimes take coordinated action to maintain global financial stability. A prime example was during the 2008 crisis, when major central banks around the world worked together to provide liquidity to the global financial system, preventing a complete meltdown. They act as the world's financial firefighters, working together to put out fires before they spread and engulf the entire global economy. This international role is a vital, though less visible, part of their mission. So, central banks are the conductors of the economic orchestra. Using their tools, interest rates, open market operations, and quantitative easing, they work to keep inflation low and stable, and employment high. They are constantly analyzing data, making forecasts, and adjusting their policies in a delicate dance to guide the economy. Their decisions determine the cost of your loans, the health of the job market, and the stability of the entire financial system. It's a job of immense responsibility and complexity, with consequences that affect every single one of us. Understanding how central banks operate isn't just for economists or investors, but it gives you the power to understand the headlines, to see the forces shaping your financial future, and to make more informed decisions about your own money. The next time you hear a news report about the Fed raising rates or the ECB launching a new policy, you'll know exactly what's at stake. Thank you so much for joining me on this deep dive into the world of central banking. I hope it's made this complex topic a little clearer. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe and hit that notification bell so you won't miss our next exploration into the forces that shape our world. Drop a comment below with any questions or topics you'd like to see covered next. Thanks for watching, and see you in the next video.